Hey everyone, it's Matthew here. Welcome back to the channel. So let's talk about something that, frankly, none of us like thinking about. But as investors, we kind of have to. War. Now obviously, war is tragic. Nobody wants it. But the truth is, it's been around as long as human civilization. And whether we like it or not, markets react to it. That's just how things work. In this video, I want to break down how the stock market typically responds to military conflicts, especially relevant right now, given the current global situation.
Overseas now, attacks by Israel on Iran are expanding, and so is the crossfire. Tonight, Israel's Iron Dome defense system intercepted a new volley of attacks from Iran.
I also walk you through how I am personally adjusting my portfolio based on recent events and some fresh data we've got on S&P 500 company earnings. Because let's be honest, when profits shift, stocks move. So we'll take a look at what that might mean for the rest of 2025. Let's dive in. Right now, there's a war going on between Iran and Israel. And since the US is a strong ally of Israel, this conflict has the potential to ripple out globally. Now look, I'm not here to pretend I'm a geopolitical expert. I'm an investor, and from that lens, I care about what this could mean for the markets and for my investments. Here is the thing about war. It often leads to higher inflation, especially in the regions directly involved. Business becomes harder. Supply chain breakdown. Local companies either shut down or scale well back. And if you are in the war zone, you are definitely not starting a new business anytime soon. But when we zoom out to the global scale, the US market is still the heavyweight. It accounts for about 60% of all global stock market volume. So naturally, what happens in the US stock market during wartime is worth paying attention to. Now here is what history tells us. When a war breaks out, stocks usually take a hit at first. That's pretty consistent. For example, after the attack on Pearl Harbor, it took the S&P 500 more than 300 days to get back to where it was. That was one of the worst case scenarios. But if you look at the average across multiple conflicts, isn't not nearly as dramatic. Typically, the S&P 500 drops by about 5% after war begins and recovers in just over 30 days. That's barely over a month. So while the market doesn't react, it doesn't usually stay down for long. That said, no two wars are alike. During World War I, stocks fell, but in World War II, the market actually went up. The S&P 500 climbed 66% over 4 years. So war doesn't automatically mean disaster for the markets. It depends a lot on the context, the countries involved, and where the actual fighting is happening. Now, that's not to say markets are immune. If a country is physically affected by the war, like its cities, infrastructure, and economy are getting hit, then yeah, their stock market often collapses. Case in point, German stocks after World War II were wrecked. But in the case of the US, historically, wars have always been fought overseas, and the US still has the largest and most advanced military on the planet. So while there are risks, we are not looking at the kind of total devastation that tanks a stock market overnight. When we narrow in on individual sectors, it's no surprise that defense stocks tends to outperform during wartime. Think companies that make military tech, fighter jets, ammo, weapons. That whole industry tends to rally when tensions rise. Now you might be thinking, okay, so war doesn't always mean stocks crash, unless you're in the country that's losing the war, which isn't exactly the US right now. But what if another war breaks out tomorrow? What would you do then? And that's exactly the question I want to unpack next. How we can prepare our portfolios, not out of fear, but with strategy and a clear head. Alright, so let's say a new war breaks out tomorrow. What would I do? Honestly, not much. Because one thing I definitely wouldn't do, and I suggest you don't either, is panic sell my stocks. I am not dumping my portfolio just because there's conflict in the headlines. The only time I sell is if something fundamental about the company changes. Maybe its growth story no longer makes sense, or it's clearly not the business I thought I was buying into. But just selling because there's war, that's not how I roll. When I look at my portfolio right now, it's built on a solid foundation. A mix of broad index funds and about 25 hand-picked individual stocks. These are companies with serious competitive edges. In many cases, near monopolies. They are machines when it comes to profitability. And I didn't just throw darts. I bought them when they were undervalued, after doing the research. So yeah, my goal from the start has been to build a portfolio that can hold its ground no matter what's happening in the world, even if there is conflict. Because historically, we've seen that markets tend to bounce back surprisingly fast, sometimes in just over a month. And if that's true, then a smart investor doesn't run, they get ready. When prices dip during uncertain times, that's when you can scoop up great businesses at a discount. Not because it's easy, but because you are thinking long term, while others are reacting short term. At the end of the day, investing is really just about making simple, smart choices, consistently. That's it, not chasing hype, not timing the news, just sticking to a solid plan and avoiding big mistakes. And that's what I try to share with you here. Now I'm 21, and believe me, if I could rewind and fix a few things, I totally would. But one thing I absolutely wouldn't change, starting to invest early. When I bought my first stock, I had no clue what I was doing. But I knew if I didn't take that first step, no one else was going to do it for me. So I got focused, starting learning, and stuck to a system that made sense to me. A lot of people wait for the right moment to invest. But let me tell you, that moment doesn't exist. The perfect time? It was yesterday. The next best time? It's right now. A year from now, you're either going to be glad you started today, or you'll wish you had. And here is why that matters. Take a look at this chart. Right now, earnings across the S&P 500 are on the rise again. And since stock prices tend to follow profits, that's a good sign. If companies earn more, their stock prices usually follow. That's the simple math behind long-term investing. Looking ahead, the second half of 2025 is shaping up to be a strong one for the markets. Green, as they say. Think about it like this. If you had just bought an S&P 500 index fund 5 years ago and done nothing else, you wouldn't nearly double your money by now. No need to time the market. No need to find the next Netflix, Meta or Microsoft. Just buy the index, stay consistent, and let compounding do its thing. So, if you've been sitting on the sidelines, don't let this moment pass you by. You don't have to catch the next big tech winner. You just have to get on the train. And if you are investing already, keep going. Keep adding to high quality companies and diversified ETFs. That's how wealth is built. Alright, that's where I'll leave it for today. If you are curious about how the Russian economy is holding up or want to know my top 3 stock picks for 2025, I've got videos on that too. Check them out here on the channel. Thanks for watching, and as always, take care, and I'll see you in the next one.